Hello and welcome to our call today titled Investing Secrets of the Wealthy, hosted by Sullivan and Company CPAs in Bethesda, Maryland. And on the call today we have Kathy Groh, EA and IAR, and Bill Issacs, CPA, who will be talking about investing secrets of the wealthy. As Kathy and Bill talk about today's topic, just want to mention to everybody the phone lines will be muted, but if you have a question, we'd like for you to write that question down so you don't forget it. Later in the call, we will open up the phone lines and take your questions and any comments that you have. I have the top of the hour, a little bit past, so let's go ahead and get started. And if you have not met either of them yet, I'll introduce Kathy Groh and Bill Issacs. Kathy is a representative of Archer Investment Corporation, a registered investment advisory or RIA firm. And with over 15 years of experience, she is here at Sullivan to assist our clients with structuring their investment selections, using asset allocation, and with the setup and management of all types of retirement plans. Kathy works with individuals, businesses, and trusts, and she is our company liaison to Archer Investment Corporation. Kathy is also a member of the National Association of Enrolled Agents and the Maryland Society of Accountants. Bill Issacs is the tax department manager at Sullivan & Company CPAs, and since earning his CPA in 1994, Bill has honed his profession and for many years has been responsible for reviewing individual, corporate, partnership, trust, and estate tax returns. And a key element of Bill's success is not only keeping abreast of all the tax laws, but understanding the implications of these laws to advise clients with tax planning and strategies. And that's why he's a natural part of the financial services department at Sullivan & Company, and Bill's knowledge of retirement plans, capital gains issues, trusts, and estates make him a comprehensive consultant when clients are evaluating their investments and dealing with life changes. So, Kathy and Bill, welcome to the call.
Oh.
Thanks, Jeff.
Yep, thanks, Jeff. Good morning.
Good morning.
Good morning, everybody. Mm-hmm.
I think, Kathy, we'll go ahead and mute the lines and let you guys get started, and then we'll open it up for questions a little bit later. How's that?
That's perfect. Perfect. Let's get started. Some of you who are joining us today are our clients, and I guess you've just finished working with Bill on your income taxes. Others of you don't have experience with our firm, so we hope that we give you a little flavor of the personalities and the knowledge that's here at Sullivan & Company. If you read the pamphlet that we're covering today, you know that the first topic is understanding the difference between average annual return and compound average annual return. But before we get into that, I wanted to define what makes a person wealthy. Is it people who have a house like Bill Gates or the ability to flash their cash and purchase fantastically expensive items? No, they might have a lot of debt to go with that flashing of money. Just think about the people that we know in the public eye who have made a whole lot of money, and then next thing you know, you hear about them filing for bankruptcy. So no, that's not the definition of the wealthy. The majority of people who have accumulated wealth don't even live in upscale neighborhoods. There is a difference between having wealth and having a large income. If you have a super income but you spend it all, you are not getting wealthier. You're just living well, living high. Most wealthy people did not inherit their wealth either. So that's not an excuse to not save. So therefore, even people of modest income can accumulate money over time if they put their mind to it and prioritize. This is not generally how Americans manage money. When we get a raise or a bonus, most people have it spent before it's in your hand. So you might want to consider, how your ancestors sacrificed to move their families forward and what we can learn from that mindset to improve what happens to our money today. So once you've learned how to put some dollars away and you want to start investing some of the savings, what do the wealthy know that you may not? So the first topic is to understand the difference between average annual return and compound average return. Let's suppose that you're looking at two mutual funds that you're interested in, and both of them have an average annual return of 5%. One earned 5% flat out every year. The other one earned 30% the first year. Wow. And then the second year it lost 25%. The next year it earned 10%. So both of these have an average over the 3 years of 5%. But let's suppose that you put $100,000 at the beginning of the first year into each of these investments. How much would you have at the end of 3 years? The one that earned 5% every year, and we're doing simple math on this, the one that you put $100,000 in, you got 5% every year, you would have a little over $115,000. The second one, the one that got 30% the first year, the second one would end up at about $107,000. You see, it's less than the one that was 5% every year. So when you read an analysis of a fund you're interested in, make sure that you pay attention to the compound annual return. You'll have a better idea of what you can expect. The compound return in our example is 5% for the first fund and only 2.36 for the second. And another thing that you should know that experience has shown and history has shown that a return of 7% over time is a very, very good return. Bill, we're ready for the next topic.
Okay. What I want to cover here is to discuss an investment policy statement. And I guess the first question you want to ask yourself is, do you have an investment policy statement, or do you know what one is? Also, do you receive regular portfolio performance reports? And I don't mean the account statements you receive, but something that clearly measures your performance against appropriate benchmarks. And does it disclose exactly what you're paying for the performance of your investments? These are two pretty important questions here. In order to make good financial decisions, it's important to try as best as you can to remove emotion from the picture. And there are three ways that this can be done. One is to set clear and realistic goals. Two is to create meaningful measurements. And three is to have defined consequences for failure. So in most cases, investors who don't even have number one, really steps 2 and 3 are really meaningless. Would be meaningless. And basically, all your decisions will end up being emotional, which can be devastating. So keep in mind what we're going to be talking about here has nothing to do with what stock to buy or to sell. It has everything to do with how to manage people and your strategies. And this is how it can be applied successfully. One is to, as I started at the beginning, is to have an investment policy statement. And basically an investment policy statement is a document, generally between yourself and an investment manager, recording all the agreements that the two of you have come up with regards to issues relating to how your money is to be managed. An investment policy statement should contain at least the following information. It should contain a time horizon for your investment strategy. It should contain your investment needs, your income needs and liquidity needs from your investment amount. It should include a decision-making policy for how your investments will be made and whom will be involved. It should include an asset allocation model, or what I mean by diversification, by which your investment portfolio should follow. It should include a provision for how frequently and by what methods your investments will be monitored and reviewed. And lastly, it should have a realistic rate of return goal, and it should be related to an appropriate benchmark. Without this, there is really no clear communication in between a client and advisor with regards to what's expected and how those expectations can be met. Good leaders and wealthy investors do not blindly trust anyone. Basically, without having an investment policy statement, I saw this as an example, it would be like driving across a foreign country with no map, no directions, and no preferred destination. So that would be step one. Step two, mentioned, was to create a meaningful measurement. In most cases, the monthly statements you might be receiving aren't adequate for most of the reporting and to show you meaningful measurements. These statements that you receive or should be receiving should contain detailed performance summaries so you know exactly what your rates of return are. And they should also contain detailed and simple descriptions of your asset allocation, again, to ensure your balance is as suggested in your investment policy statement. But you will find that many firms are hesitant to provide this type of service, primarily because it's, one, very expensive to administer, as well as very revealing of the true results of your investments. But without this type of reporting, it's impossible for you to make it to step three of this process, which would be then accountability, which then gets into consequences for failure. There's never been an argument for why a company should fire slowly. Investors should react no differently, and if their portfolios are not doing what they intended to do. So for example, if your investment policy statement says you have a time horizon, it's 3 to 5 years, and your rate of return expectation is to exceed that of the S&P 500, you should give your chosen investment plan 3 years to identify whether or not it's reaching that stated goal. I see it. I came across a definition here that is talking about a definition of insanity, which says to continue to do the same things over and over again and somehow expect different results.
I think we all do that a little bit.
Yeah, you got to be careful with that.
Yeah.
So, for most though, if you do follow the steps 1 and 2, you will know definitely what to do for step 3. And the key is to follow through on your plan, be methodical, and do not let emotional interfere with your better judgment.
Yeah, one of the things that I would add to that is that many times when people are only looking at their statements, they're looking at short-term performance, either good or bad. You know, they're real excited because something is up a lot, or they're really down in the dumps because it seemingly is hitting the floor. But these other analysis help you to know how the investment is doing according to tracking from the beginning of when you put money in, and what the expectation is going out further into the future. And important in the setting of the goals is being, realistic, because, in Bill's example of, a 5 to 7 year window, the percentage that you expect that to grow has to be reasonable for the market. It can't be just what you need. Otherwise, we would all pick 20%, and that's not reasonable. So you do need to have good investment advice, which is what I'm getting ready to talk a bit about. Was there anything else, Bill?
No, I think that was all I needed.
You're okay.
On that. Yep.
All right.
Mm-hmm.
All right. The wealthy, they do understand that nothing is free and that things worth having have a cost. So investing on Scottrade, which is inexpensive, may be enjoyable, or you may be an analyst and you do well with Scottrade. But for most people, Scottrade is not a good option. In other words, doing it yourself. So who is out there, and how do I pick the right person? So let's start with your 401k. Who will advise you how to invest in this? Typically, those are called self-directed accounts, and you really are on your own. There are brokers who are knowledgeable and helpful, but they don't give advice. And what I mean by that is, if you say to Vanguard or some company like that, if you say to them that you want a growth fund, they can tell you what growth funds they have, and they can tell you all about what's in the growth fund, but they won't help you understand whether a growth fund is right for you. So you're on your own, typically in a 401k. There is free advice out there. sometimes companies offer free financial plans. I think a client told me that Schwab will do that for you. You should recognize that doing a financial plan takes a lot of time. Do you really think that it's free? Of course it's not. They're using the plan as a marketing tool to persuade you to invest with them. And sometimes in these types of situations, what they sell you after the financial plan is more expensive than if you had paid for the plan, gotten good advice, and invested based on your new knowledge. I call myself a financial advisor, but you should know that that's a very broad term. Is the person independent, or are they tied to a brokerage house? Do they charge by the transaction, receive commission, or work for a fee? None of these arrangements are necessarily good, bad, better, or best, but you need to know how they are compensated and judge whether that method works for your situation and if they are working in your best interest, which is so very important. If they charge for each transaction, will you find them calling you often to make changes so that they can make money on the transaction fees and commissions? Abuse of this practice is illegal, and it's called churning. But if you think about this whole concept, it would be very hard to prove that someone is churning your account. If they receive commission, you really need to judge this based on your portfolio value, in my opinion. If an account is relatively small, you may find this preferable to the fee-based, but you need more information so you can determine the true cost. Fee-based investing is generally the preferable way to compensate your advisor. If he's involved in your decisions, then a percentage of assets is a reasonable formula for compensation. If your assets grow, it's to his credit, and his compensation goes up. Generally, the percentage that he gets lower the larger your account is, so that the dollars do not become exorbitant. But it should never be free. You should never be looking for, the fees to totally go away. When somebody of significant wealth is looking for a financial plan or investment advice, they fully expect to pay for it. However, you should also know that many of the nation's leading money managers require performance incentives that can drive their annual fees to over 10%. Some of these firms require minimum investments of over $20 million. So even the wealthy, there's still sharks out for people who are in a class of their own. So anything good has a cost. The cost should be fully disclosed, and you should be able to understand it. You could be surprised to know what the true cost of your personal investments are. The cost should go along with the economic benefit that you're receiving.
Okay.
Yep.
Well, the next thing we want to discuss here is just to realize that most investments just may not be appropriate for you. Just realize there's one of the most common investments that's out there is a loaded mutual fund. And as a whole, mutual funds are a great idea and can work very well for most people. But we'll find that the very rich generally don't use loaded funds. And something that you might also be seeing financial people selling these days are annuities. And they come in wide varieties. And a lot of times most of them sound too good to be true. Most successful money managers do not use annuities. I'm not saying that neither one of these cannot be good, but just need to be careful of what's going to be good for you in your case. As we've seen in the news in the past couple years here in particular, the number of scams and shams and schemes that are out there. And again, things that might sound great, just need to be careful. I came across a thing here, an interview done by John Bogle, who's the founder of Vanguard Funds, and he's explaining the cost of mutual funds. And he gets into where he talks about an individual who is 20 years old today and is starting to accumulate for retirement. That person has about 45 years to go before retirement. It's taking them from age 20 to 65. And then if you believe the actuarial tables, another 20 years to go before death. So that's about 65 years of investing, and points out that if you invested $1,000 at the beginning of time and can earn 8%, that $1,000 will grow to be somewhere over $100,000. He also points out that now in the financial system, let's pick annuities in this case, they will take about 2.5 percentage points of that return, so that your net return really is only going to be about 5.5%, and your $1,000 will grow to be approximately $30,000 to you. So if you think about it, that means that the financial system basically put up 0% of capital and took 0% of the risk, and basically got 8% of your return. And you as the investor in this long time period, an investment lifetime, put up 100% of the capital. You took 100% of the risk and only got about 20% of the return. That's a financial statement, the financial system that's failing investors because of these costs of financial advice, brokerage, and some hidden and some out in plain sight that the investors, that it's not in front of the investors. They have no idea. And he was pointing out so that this system needs to be fixed. Came across something else that a consulting company found that during a 16-year period that the average stock fund returned 14%. And during that same period, the typical mutual fund investor had about a 5.3% of return. They point to us that they believe that this is due to the fact that most investors, either themselves or broker-led, continue to buy high and sell low. And it's coming mostly from chasing funds that performed well the year before, or current, or within the last year or so. So we're finding that this does happen a lot. So you just need to be careful and to make sure that the investments you're in are appropriate.
That's so true. The chasing yield is a real trap, and that's where, you know, having a good advisor and using your head and not your emotions is very important. So who do the wealthy use other than folks like Bernie Madoff? You know, and you have to think about him too, as you know, he had wonderful credentials, and I do have a lot of sympathy for the people who were with him, because there was really nothing about him and what he had done in the past that would have made you suspicious, except any time somebody is offering you extremely high returns and consistently giving you that, you have to think that's not reality. So you know, do be careful about being approached by unrealistic expectations. If you have an investment portfolio of $250,000 to $500,000, there are a lot of people who are interested in your business. If your portfolio is $500,000 to $2 million, the potential managers, they'll start to line up. And if your portfolio is $2 million or greater, some will even beg you. So you should know that you are in the driver's seat no matter what your balance. This should not be understood that they will change all their fee policies for you, but it means that you can see what the competition is doing and see what fits you best. There are different types of people, and we're going to talk about a few of the ones that are out there. First, there's bank money managers. In our work with accounting clients, nothing makes me cringe more than when a client says they're working with or considering working with a bank. Inside the banking industry are thousands of money managers, and this would make you think that they are experienced and have a good structure in place to serve their customers. But within the banking industry, they have a historical reputation of paying employees less than the industry standard. And I'm talking about, in this case, they're paying less than the financial investing industry. In other words, they're in line with banks, but they're not in line with financial. So in a highly competitive field, it's hard to attract and retain high-quality employees with low-paying salaries, right? So if a bank manager were really good at this, why would they be working for the bank? So if you know a branch manager well personally, you will also know that they have quotas to fill in order to earn raises or bonuses, or I can think of a couple of times when I've heard that it has everything to do with whether they'll keep their job. So does this type of incentive put the money manager on your side? The wealthy are not going in and out of the corner bank to get financial advice. Then there are brokerage firms like Merrill Lynch and Morgan Stanley. Employees in this arena are between a rock and a hard place, in my opinion. They've had a lot of training, and they may really want to serve you well. But their training is more sales-oriented, and more damaging than that is that they are proprietary organizations, and therefore they need to push the product that their company has produced, in these cases the mutual funds that bear the name of Merrill or Morgan Stanley. They also must make quotas. They receive calls from management telling them to push a particular product. That's because the brokerage house has bought something in bulk. I mean, this isn't too different than the retail store. They've bought it in bulk, and now they need to turn it around quickly. So the pressure is put on the representatives to sell that particular product. So this is necessarily going to get in the way of his ability to have your interests foremost in his work. The next group are brokers and financial planners, and this is generally a good group of people. They do have a conflict on how they spend their time, however. In order for most brokers and planners to earn a good living, they must be well trained at managing relationships and selling. At the same time, they're trying to manage portfolios. This is really an insurmountable task, and they wind up being good at one aspect and not the other, or being mediocre at both. Some have turned to wrap accounts. I don't know if you're familiar with them, wrap accounts or third-party managers, in order to solve this problem. In other words, they work on the relationship with current clients and prospecting for new clients. And then they have the third party do the managing of the account. The weakness in this arrangement is that the money manager, the person actually handling the money, is not working directly with you and is dependent on the communication from the planner. If the planner chooses the wrong manager for you, they'll get you a new one. You know, if things aren't going well, they get you a new one, and it's never exposed that maybe they didn't do enough due diligence at the beginning to make the arrangement work well for you. So at the end of the day, even if all goes well, both the planner and the money manager have to be paid, right? So this can lead to above average costs when compared to dealing with just one or the other. So the next group is the private wealth management company. This is actually the preferred method for many wealthy investors. When working with a private wealth management firm, the financial planning and asset management are done at the same place, and it's done exclusively on a fee basis. There are multiple professionals that each have their defined responsibilities, so getting good service from someone that only does service is not an issue, yet having access to the money manager is also available. By having the varying components of the wealth management team in the same location, it is very easy for them to interact and provide a seamless service, offering a high level of customization. So the drawback to this type of service is the limited number of clients that these firms can work with, and so they have minimum investment amounts. Most firms require no less than $250,000, and some require as much as $1 million. And I do want to mention here that in any of these cases, the more money any of these professionals have to work with for your account, the more customized they can be for you, because asset diversity gets greater and the availability of investments that may have minimums to buy, then become available. So when we talked about people lining up to get your account, some of the salivating for a wealthier client is that, the manager can use more of his abilities to get a good result for the client. There are limitations when you're only working with, say 8,000 or something of that sort. There's not a lot of options. So let me finish today's session with why a CPA firm like Sullivan and Company is involved in financial services. As some of you older people might know, for years CPAs were not allowed to be licensed to sell financial products. It seemed like they were crossing a line and entering a shady endeavor. The brokerage world was filled with greedy people who wanted to sell a lot and cared very little for the goals of the client. I mean, there has been a real evolution in the financial world in the last 30 or 40 years. The CPA has long been held as the objective partner to the business owner and a reliable, trustworthy source of tax advice. In this capacity, CPAs as a group saw how their clients were treated by the financial world, and they were not happy. Fortunately, there were some crusaders in the CPA world. They fought to be able to be more involved in what happened to their clients' accumulation of wealth. They have always been problem solvers for their clients, objective and not selfish generally. Client service is their priority, so why not serve the client in this capacity? Sullivan and Company works with one money management company with high ethics and great ability. Fees are low, and our clients have access to the money manager. We are able to coordinate your tax objectives with your financial decisions. Let me just list the areas of your life that your CPA, whether it's Sullivan or not, should be involved in. Almost all of these areas include financial decisions. So make sure that you keep your CPA informed, preferably before you make decisions. And then some of the things that we talked about today, it's so true. You know, if you're talking to someone about an annuity and it sounds like it's a good fit, bring your CPA in. Let him know what it is that you're considering and why, and he can help you decide whether this is a good idea or not. So these are the things that your CPA should be involved in. He's certainly your tax counsel. He should be involved in your investment planning. He should be involved in your retirement planning, your asset protection, your income preservation, your estate planning and transferring of wealth, business planning, succession planning. What are you going to do with that business when you don't want to work it anymore or can't? Unique needs or life events, things like divorce, major illness, debt management, and education funding. So all of these you should have your CPA involved in, and so that is why Sullivan and Company includes, having a financial group to work with you. So thanks for joining us. Jeff's going to field some questions now, and we hope to hear from many of you as you begin to look at the choices that you have in more of the same way that the very wealthy do. When you meet with me, be sure to ask how to calculate what type of wealth you should have accumulated at this point in your life. Jeff?
Thanks, Kathy. The lines are open, so if you do have a question, just go ahead and ask it. And I've got a couple questions here that have come through the website, but we'll give everybody on the phone a quick chance first. Is anybody out there on the line? Again, if you have a question, just go ahead and say something. I'm sorry, go ahead. I can hear somebody talking, but if you can speak up a little bit. Well, maybe not. Kathy, here's one question that came through the website. You hear a lot about mortgages now, refinancing, paying them down. What's your advice on them?
Well, I think I can answer that, too.
Okay, Bill.
Advice in general is, it's different with every situation. Of course, that seems to be the standard answer, but it is. But I guess what I hear a lot is people like wanting to keep their mortgage because of a mortgage interest deduction. And just wanted to point out, one thing about that is that keep in mind, mortgage interest, although is a write-off, it is going against your income directly and not against the taxes directly. So what I mean by that is that it lowers your income by which then the tax is then calculated. So you're not saving dollar for dollar in taxes. You're really saving possibly somewhere between 30 and 40%. So just kind of keep that in mind that, okay, you might have the mortgage interest, but it is only a 30 to 40% possibly savings tax-wise. You're losing the other 60 to 70%. And just to have mortgage interest as a deduction may not be the way to go on something like that.
Gotcha. That makes sense. Second question here says, my wife and I have a good relationship with our bank manager, and whenever she suggests a different use for our money, I think meaning the bank manager, my wife is ready to go with it. Listening to you makes me wary. How do we keep the bank relationship? How do I get my wife to realize we might not be doing the best with our money? I don't know, Bill, if that's you or Kathy.
That's an interesting question. Well, I think it's pretty easy to keep the relationship at the bank, although the initial might be a little difficult. The first thing I would do, though, is you might want to share this webcast with your wife and let her listen to it on her own time, and think about what may be motivating the very nice bank manager. And they're not intentionally taking advantage of you. I don't think that's the case at all, but they have these other pressures that make it difficult to do necessarily what they should do. So I would literally share the webcast with your wife, and then the next thing is to search for who you do want to work with. And once you do that, then they can help you transfer from your bank manager, and you can drop her a line, or you can go in and let her know that you've made a change and that you're more comfortable with the independent person. I think that's what I would do.
Okay. Thanks, Kathy. Again, the lines are open on the phones, so if you have a question, just go ahead and say something. And if not, it looks like we have one more question from the Internet. It sounds like I should be looking for an independent advisor, but everybody seems to be linked to someone. You're with Archer. How does that work?
Yeah, that's rather complicated. Let me try to simplify it as best I can. No one can deal with Wall Street directly. You can't just call. I don't know. You can't call Wall Street and say, I'd like to get 10 shares of IBM. So you have to go through a brokerage house. A brokerage house has to have enough assets to be able to handle the trades. So everyone that you would consider has to trade through someone. So they might trade through Pershing. See, these are some of the large houses that independents use. There's Pershing. There's National Planning. There's several. We use Archer. It's who uses Trade PMR, which is a smaller brokerage house that only works with independent advisors. So you have to work through someone. So when you're talking to people, it isn't so much who they're trading through, it's where their compensation is coming from. I think that's the correct question. The other thing is that FINRA, which is a like a governing, what would you call it?
Association?
Yeah, they they make sure you're doing things right. You have to report to them, et cetera. They're a watchdog. They're kind of a watchdog. Okay, they have a website, www.finra.org. you can go on there and you can look up the advisor that you're thinking of working with and see if they're in good standing. And that's a great place to start.
Okay, super. We still have the lines open. If you have a question, you're welcome to say it. And Kathy, if as we're listening, if somebody, after listening to what you and Bill have discussed, if they have a question about what they have in their portfolio, analyzing it for whatever, either return or asset allocation, do you guys offer a service?
We do. That is our typical starting place with our clients, is that we look at their portfolios, we look at what they're invested in, we have it looked at by an analyst, and give them feedback on how it looks. Sometimes they're wonderful, and we say, way to go, keep it up. Sometimes it's troublesome, and so we give you feedback on how it looks and what we think would be a better way to go. So that initial analysis of what you have is free, and of course nothing is free, but it is a service that we do provide for our accounting clients. You are paying us for your accounting services. So we do that part free. And then, obviously, if you invest with us, then we'll make some money in that area. But it's certainly not required, and it does not happen every time. So you should not feel pressure that way. We'd be glad to look at what you have, including your 401k accounts.
Okay, great. And if somebody's not a client that's listening to this, either live or on the replay, what's the phone number that they should use to get in contact with you?
It's 301-657-8080, and I'm extension 135, and Bill is 119.
Okay, great. Well, Kathy and Bill, are there any other issues or last-minute things that you want to mention to everybody on the call?
No, not at this time. I don't. No, I do not.
Just glad to be done with tax season, right?
Yes. Although extensions go to October 15th, so
great.
It's still out there.
Busy. Yes, it is.
Good. Well, we're glad from both sides of the table everybody made it. We do want to thank everybody for being on the call, whether you're listening live right now or on the replay. And again, if you have a question for Bill or Kathy or anybody there at Sullivan, the phone number to call again is 301-657-8080. And if you have an interest in a portfolio analysis, just want somebody to give you a second opinion or look over your shoulder and see what you have in terms of past performance, or maybe there's a change in your business or personal situation and you need to adjust going forward, give Bill or Kathy a call. Kathy and Bill, thanks again, and we appreciate your insight. And again, thanks for everybody for being on the line, and we will talk to you soon.
Okay, thank you.
Okay.
Yep. Bye-bye.
Bye, everybody.
Bye.